Welcome. I'm here today with Snita Balsara. My name is Kevin Madill. The theme of this session is fundraising, and specifically some of the top questions we get as VCs as we're working with companies. Snita, do you want to start by telling us a little bit about Mars IF?
Absolutely. So this is Snita Balsara and Kevin. Both of us work at the Mars Investment Accelerator Fund. We're a seed stage fund focused on Ontario-based companies. We do 10 to 15 deals a year. Our team is based in Ottawa. So Kevin and Lance Laking are based in Ottawa. We have Aaron Bast in the Kitchener-Waterloo area. And then the remainder of the team, the bulk of us, are in the Toronto area. We've been around over the course of the past 10 years and invested in over 150 founders in the Ontario ecosystem. And we're really proud of that. Personally, I've been with the team for about 4 years now. My background is in, is a tech business background, was in ops at a big corporation, dabbled in the cybersecurity world a bit. And as most people in venture capital have a non-traditional route to venture capital, mine as well was the same. My stepping stone into venture capital was actually managing Robert Herjavec's Shark Tank portfolio, and just kind of got that finance bug and really loved this world that we're in and joined the IAF now. Kevin, you're a newer addition to our team.
Yeah, my path is also unique, I guess, as you said. My background is being an entrepreneur. So I'm an engineer by trade, and shortly after graduating, I started a company called Myovision. Grew that to about 30 million in ARR and about 150 people. Now I'm very happy to be on the other side of the table, or at least experience something different. I also was very happy to be an entrepreneur with Mars IF here based in Ottawa.
That's awesome. It's been great having you on the team and bringing that founder perspective to the work we do. And hopefully in this conversation, we get a bit of your perspective from both sides of the table as we talk about some of the main questions that we get asked. I think a stepping stone or a very fundamental questions that founders think about is what type of funding is right for my business? And would love to hear how you guys thought about it, Kevin, when you were with Myovision and some of the things that the company should be thinking about as they think about it for themselves.
Yeah, I think one of the main questions founders first ask themselves is, should I raise money at all? And that is maybe not as obvious as an answer as some might think, because I think it is one of those, it depends. For most tech companies who want to be high growth, I do think it's probably the best path to raise external funding. When you have competition, when you want to grow quickly with sales and marketing, you're going to need external capital. That being said, it's not the only path. Some businesses may be able to get the growth they would like from their own cash flows. And it's also fine to want to be a business that maybe doesn't grow so quickly, what some people refer to more as a lifestyle business. Do you want to talk, Snita, a little bit about your experience with that and what you see as some of the advantages and maybe disadvantages of raising capital?
Absolutely. So I think, Kevin, you hit it right on the head there, that like step one is for the founder to assess that self-assessment of what really works for them, what type of business do they want to run, and then finding the right funding sources to make them successful there. So speaking of pros and cons of different approaches, as you get into venture investors or you're taking investment from others, there's an expectation that you're also going to be a steward of their capital and that you will generate a return for them on that investment. There's going to be a bit more governance and involvement when you take capital from others in the form of a board. There's also shareholders that you'll have to update and report to as well. The opposite approach, when you're going at it on your own, you maintain all of the equity, you hold all of the equity, you're not having to kind of answer to others, if you will, not update others, but then it can be a lonely journey going at it on your own. Sometimes it's helpful to have a board of advisors or a board of directors to reach out to with business problems, and just ideate on how to solve them with them. And also it expands the network having that board there, because everyone's invested in the success of the business, the success of the founder, and will open up their network of resources to help there.
Yeah, that was exactly my experience when I was an entrepreneur, is that it does add a layer of overhead in terms of managing shareholders, etc. But investors can also be a great help and also add a degree of professionalism that you may not always hold yourself accountable to without that external party.
I think the next logical question for a founder to ask themselves once they've decided, yes, I want an investor, yes, I want to go out and look at raising external capital, is what type of investors are right for my business? What are the different stages with which folks invest at too?
Yeah, there's a number of different types of investors. The first, maybe most obvious, is yourself. So putting your own money into the business in the early days, and also your own time, sweat equity. Typically, the first, or at least often, the first round of external money that an investor or an entrepreneur will raise is a friends and family round, sometimes called friends, family, and fools. This is, as it sounds, going to friends and family and asking them to invest in your business. Can be a great source of capital. Of course, you need to be comfortable, and they need to be comfortable with the risk profile that they're investing in. Tech startups tend to be riskier investments, especially in the earlier stage, and so you have to be comfortable at Thanksgiving dinner or whatever the case might be, that you're now have taken their money and have set expectations with them that they may truthfully not get it back, but it definitely a good route to go down for many. In my company, we chose not to do that, partially because we weren't comfortable with that, and partially at that stage in our life, we weren't surrounded by friends and family who were in a position to make that investment, so we went without. Typically after that, angel investors are the next place to look for capital. An angel investor is a wealthy individual who is investing their own money. So what's great about that is they can make a decision very quickly. There's no investment committee, there's no external decision-making factor, and they're also often investing not just in making returns, although that's probably part of what they're thinking about. It's also, they like the founder, they're giving back to the community because probably someone invested in them at some point in the past. Typically, angels are investing 25 to 50K each. Could be less, could also be could be more, but that's typically what we see. And then expanding on that, you have angel syndicates, the likes of Capital Angel Network, Equation Angels. There's others in Ontario, and some are specific to certain fields like Halo Health, where angels get together in a group and then together share some knowledge and expertise and some due diligence on whether they're going to invest. So it tends to be a little bit slower because they go through a little more process than an individual angel typically, but that's often another route that you see. And the advantage is you're not going to individual angels getting 25 to 50K each. You might get 150, 200, $300,000 in that angel syndicate. So do you want to talk a little bit about later stage past the angel rounds?
Yeah, absolutely. So you'll find that sometimes these stages blur a wee bit together. So it's very common that angel syndicate groups will start to invest alongside some of the early institutional investors. And institutional investors generally land into a category which is where their sweet spot to invest in. So you'll have some pre-seed pre-seed type investors. So Panache Ventures would be an example there. You'll have seed stage investors. So Panache also invests at seed, and Mars IAF is very much of a seed stage investment group. And then you'll have other groups that focus on Series A and above. So at the different stages, you're gonna start to experience a bit more process and rigor in that diligence, a bit more gating as to like what's the stage of the business, that helps determine which stage of investment you're going for. So at the seed stage particularly, we're looking for tech to be developed in market with some early market traction. Generally, the MRR that our companies are experiencing in a SaaS business is in that 50 to 15K to 50K in MRR, and really hitting a good growth trajectory there. As part of our diligence process, we really have it's really important to us to have a conversation with some of the clients, the customers that are paying the company and using their services to really understand that pain point and validate that the solution is effective there. Now, the IAF is very much of a generalist type of fund. You'll find other funds that are much more industry focused. So an example could be IGAN or Lumira, who are more focused in the health tech space. Another type of fund is an impact investment fund. So Amplify Ventures would be an example there. So they're looking at the business's returns, but then alongside of that, the business's impact on the United Nations SDG goals. So there's a variety of investors that come in at that at those early stage into institutional investors. Another consideration for a company is, do I look at Canadian investors or US investors? Kevin, I'm curious as to how that was, how you guys thought about that with Mile Vision and in your fundraising process.
Yeah. For me, all things being equal, my preference is to raise money from Canadian investors. I think when you're in your earlier rounds, such as angels, that typically they're in your own ecosystem. So at that point, definitely for us, we were based in Kitchener-Waterloo. So most of the angels came from there or Toronto. I like raising from Canadian investors partly because I like the idea that any wealth creation that occurs then stays within Canada and helps to grow the local community and the country as a whole. The other sort of more financial advantage for the founder personally is that you do benefit from a lifetime capital gains exemption. So you pay less tax on an exit should the ownership of the company remain above a certain threshold of Canadian ownership. That being said, raising from US investors is also something definitely to consider, especially with the US dollar being as strong as it is. The valuations are sometimes higher, which means you can either raise more money or take less dilution, which are obviously important considerations. Ultimately, it doesn't need to be an all or nothing. So with Mars IF, for example, it's very often that we're having co-investing with other investors who are a mix of both Canadian and US. I think in the end, it's best to look at all your options and see what is a fit based on both your personal values and the financial side of it, and all things considered.
Yeah, and to that point, we've seen a lot more movement in the ecosystem whereby US investors are more active in Canada, especially during this shelter-in-place COVID-19 world where folks aren't traveling as much. It's easier to set up a bunch of Zoom meetings and connect with folks more efficiently.
Yeah. Snita, when do you think is the right time to approach investors?
I think it's really important to build a relationship and rapport with those investors, and that doesn't happen overnight. So it's in the company's best interest to start those conversations before they need to fundraise. And the purpose of that is not just to put your company on the investor's radar, but also to learn about the investor. Is this a fund that you'd like to have on your cap table? What does this fund's process look like? How long does the process take with them? What's the decision-making model with them? Those early conversations also give a company an opportunity to understand what are some of the risks that investor sees with this business. It allows that company to then, take that information, go away, so that for a subsequent meeting, if you choose to have it, you can say, here are some of the things you thought were risks. This is what we've done to de-risk it. That being said, we do meet as investors with a lot of companies. I think the fund, we've talked about this, we see 300 to 500 companies a year, but we only end up doing 10 to 15 deals a year. So we're really focused on taking companies through the process when we think they'll be successful in the process. Kevin, would love to hear your perspective, because you've now seen both sides of it, as the founder and now on the investor side. What were maybe some insightful learnings you gathered?
Yeah, I think a lot of what I was told was the case, being now on the investor side, it really is actually feeling that and seeing it firsthand from that perspective. So, to your point of seeing 300 to 500 deals, I'd always heard that number, but often as the person pitching the company, I don't think I really internalized how high that bar would then be to be one of those 10 or 15 investments that were made. And sometimes it felt like, well, if the investors are there because they want to invest, well, then why aren't they investing, or why aren't they choosing to invest in my company? And that was always sort of a feeling I had, if I got a no, which of course happens before you might get a yes. But being on the other side, you really realize when you're seeing sometimes 2 or 3 companies a day, how high that bar really is, sort of seeing that firsthand. The other thing that maybe surprised me a little bit is how much as an investor we want the pitch to go well. We want to see a company that we want to invest in. When you're the one pitching, it often feels like you're being asked difficult questions, holes are being poked, we're asking about risks. It can really feel like almost adversarial sometimes in terms of the questions you're being asked to answer. And what you don't necessarily realize is on the other side of the table, as the investor, we're really hoping that this is going to be, you're going to have the answers because the business is in the right spot. And that is something that I guess to some extent surprised me, or at least feels a lot different, because I don't think the investor always shows how much they're hoping you'll be successful in the way the questions can sometimes, and the due diligence process can sometimes be asked or undertaken.
Yeah, that's a really good point. I think something that maybe founders don't realize is the process that we're going through on our side to screen a company to ensure that, when we bring it in front of our partners, that it's something that we can get buy-in across the table, so that we can invest time in there. Another question that is pretty common is on the vein of like, when's the right time to approach investors is, do you start to raise before you're pre-revenue? Do you wait until you have revenue traction? Do you get a better valuation in one camp versus the other? What are your thoughts on that, Kevin?
I really liked your point you made earlier on building a relationship and reaching out potentially earlier than you might expect, getting to know the investor and giving them a chance to know you. When you do come to an agreement on taking investment, you really, it is in many ways a marriage. It could be a decade or even longer that you're now together with that other party. You want to make sure that you're taking money from someone you want to work with for that period of time, and also understand the metrics that they're looking for to actually make an investment. So I do think reaching out early is a good approach, but do be sort of mindful of how much time you're spending on that if you're not truly ready from a stage perspective, whether it be revenue level or some other metric or some other proof point, that you're not spending all your time building those relationships, and that that you have set expectations properly with yourself and set time accordingly.
That's a really good point, Kevin. I think is something that folks don't realize is that it is a process and it does take time. A deal that I did this past year, we met the founders about 2 years ago, and tracked them over that period of time, and they kept saying that they would execute on X, Y, and Z, and they would execute on X, Y, and Z, and then they kept us up to date with quarterly investor update, and said what they were going to do and then did it. And that was a nice way that built, that they were able to build rapport and confidence with the investor base.
Do you have any thoughts on raising money pre-revenue versus post?
I think it depends on the stage of the company and the type of company that you're in, and the risks that the company is going to face that they need to demonstrate and de-risk. So, in cases where there's a product risk type of base, so like looking at deep tech type of businesses, you can probably start having those conversations pre-revenue, because those investments are going into executing on this product roadmap. But if there's market risks associated with it, you'll need to de-risk some of that market risk as you speak to those investors. If you're in a very highly competitive space, there's a lot of other players there, and your thesis is that my product is better for X, Y, and Z reasons. Some of that validation needs to be there, especially for myself in a generalist fund here.
I agree. I mean, the other side of that sometimes I've been asked is around whether you can get a better valuation pre-revenue than post-revenue. It does, to your point, depend a little bit on the industry you're in and the type of company you are. I would say most investors prefer to see revenue, and as a result, valuation is better after revenue. What can sometimes happen is pre-revenue, you're pitching more of a vision and a big mission, and then post-revenue, when you actually start to have some revenue, well, then evaluation can be sort of calculated or determined, partially at least, based on those revenue numbers. And that's why that sometimes, I think rarely, you could see potentially a drop in valuation. I think that really truly only happens if those revenue numbers stay low for a relatively long period of time. If you're showing consistent growth at a good rate, then I would choose, both as an investor and as a founder, getting revenue every day of the week. In the end, you're building a business to build a business, to get customers, to generate revenue, not to effectively raise capital.
Yeah, absolutely. I agree with you there. Maybe just we'll hit one more question quickly. And that's, for a company to figure out how much should they raise. Like, it's such a difficult thing to plan out that part of the future. What are your thoughts there, Kevin?
Typically, I think the right number is 12 to 18 months of runway. And in addition to that, you need to raise enough money to get to the metrics you need to comfortably raise your next fundraise. So to get to those fundraising milestones, you don't want to be in a position where you're kind of in between, not quite there to get more money, but now you're running out. So typically that we see that to be 12 to 18 months. You should plan on it taking roughly 6 months to close your round. And of course, you don't want to be raising money all of the time. You should be building your business. And so that's why having the 12 months to get to those milestones and then another 6 months to make sure you're closing the round seems to be the right level.
Yeah.
Do you have anything to add to that, or any tips to share with us on running a fundraising round?
So running a fundraising process, I think just recognize that it's going to take time. There's a bit of patience required there, and establishing your own CRM for for how are you going to keep track of the investors that you've spoken to? When is the right time to re-engage them? What are some notes on them? Like that's really important. We spoke about the quarterly update emails or monthly update emails. That's really helpful. And having two lists, so one for existing investors and one for potential investors, and then sharing the right information with them. Setting up an easy to use, easy to digest data room is really important. So having your information grouped in folders so that after that first meeting, if an investor says you'd love to dive into your data room, you can open up that to them relatively easily. On the fundraising, the time, the how much to fundraise. The other thing I'd add in is just some of the analysis that we do in that process to determine, is this company raising enough, is we look at that financial model and, assuming we believe the assumptions that are made and we have confidence in that, figuring when the company is set to run out of funds, and then looking back a few months to say, are they at the milestones to reach that next fundraise level, or are they falling short a little here? And then seeing, does it make sense for them to raise, instead of 12 to 18 months of runway, 18 to 24 months of runway, just to give them the needed buffer to hit those milestones.
Perfect.
Yeah.
Well, I think we've covered a fair bit of ground in this. What I would say to anyone watching this is, don't be afraid to reach out to us. We'll make sure our emails are available. We've really only scratched the surface on these topics, and I'm sure other ones that you'll encounter as you continue your journey. We're happy to get to know you early, well before you're actually ready to be at the stage that we invest in. So please don't hesitate to reach out with any questions you might have, and just to get to know us better. Anything to add, Snita?
No, thank you so much for your time today, Kevin, and sharing that perspective from being in the founder seat and now on the investor side. It's really nice hearing your insights there.
Thank you. It's been a lot of fun to experience both sides.